You ever look at a stock chart and just see a bunch of squiggly lines? Like you're trying to read some kind of alien language. Well, today, we're going to start decoding that language. We're going to figure out how to spot the simple stories that are hiding in all that noise. So let's jump right in.
I mean, look at this. At first glance, it really does just look like random chaos, right? But what if it's not? What if there are shapes and patterns hidden in there that repeat themselves? Patterns that actually tell us a story about where the price might be heading next. The big question is, can we learn to read them? And the answer is, yeah, we can.
So, let's start with the absolute basics. No matter how complicated a chart looks, it's really just telling a story. And you'll find that most of these stories follow one of two very simple plots.
Okay, so first up, every story has a direction. Is it a bullish trend or a bearish one? The classic way to think about this is a bull, right? It thrusts its horns up. That's a market where prices are generally rising. And the opposite is the bear, swiping its massive paws down. That's a market where prices are falling. It really is that simple. Are we going up or are we going down? Bull or bear? But here's the thing. Prices almost never move in a perfectly straight line. They tend to bounce between two invisible levels. Think of resistance as a ceiling. The price goes up, hits its head, and struggles to push through. And support, well, that's the floor. The price falls, lands on it, and often bounces right back up. These floors and ceilings are what end up creating the patterns we're looking for. So, when the price starts hitting these floors and ceilings, one of two things is usually about to happen. First, the trend might just be taking a little breather before it keeps going in the same direction. We call that a continuation. Or the trend has totally run out of gas and is about to flip around and go the other way. That's a reversal. All right, let's dive into that first plot type, continuation patterns. This is what you see when a really strong trend just needs to pause for a second, catch its breath before it makes its next big move. So, picture this. A stock just takes off like a rocket. A really powerful, almost straight-up surge in price. Because of how it looks on the chart, traders have a simple name for this initial move. They call it the flagpole. Now, after that huge run-up, the price needs a break. It starts to drift sideways or maybe even a little bit down, kind of forming a small tilted rectangle. And that little rectangle, well, that's the flag on our flagpole. The really crucial moment here is the breakout. That's when the price finally smashes through the top of the flag, signaling, okay, break time's over and we're ready to keep climbing. And there you have it, the bullish flag pattern. It's a classic continuation signal. You've got the pole, you've got the flag, and you've got the breakout. It's a beautiful visual story of a trend that paused, gathered its strength, and now looks ready to keep on running. But, no trend can go on forever. They all run out of steam eventually. So now, let's look for the patterns that signal a major plot twist is coming, a complete change in direction.
And what's so cool about these reversal patterns is just how intuitive they are. Seriously, it's almost like the market itself is drawing you a picture, giving you a heads up about what it's planning to do next.
I'm not kidding. Sometimes it is literally as simple as the letter M. This is one of the most common and recognizable signs that a strong upward trend might be getting tired and ready to roll over. So here's the story the M pattern tells. The price is rallying, it hits that ceiling, that's your first peak. Then it pulls back, finds a temporary floor, and tries to rally again. But it just can't break through that old ceiling, and it forms a second lower peak. The real confirmation, the moment of truth, is when the price falls and crashes through that floor, what traders call the neckline. At that point, the buyers have probably lost control, and the bears are taking over. So this M shape, it's officially known as a double top. It's a classic bear signal that things might be headed down. And of course, it has an opposite. A W shape down at the bottom of a trend is a double bottom, and that's a bullish signal. So you can think of it this way, M for market misery ahead and W for a potential win. Okay, so now that you can start spotting a few of these patterns, we need to talk about the single most important rule of all, and it is this. This is not a magic crystal ball. Look, chart patterns are all about probabilities, not certainties. Think of them as clues in a detective story, not a signed confession. They are suggesting what might happen, not guaranteeing what will happen. And they absolutely can, and often do, fail. So how do you use these things wisely? Well, first, be patient. You have to wait for the pattern to be confirmed, for that breakout to actually happen. Second, always remember it's a game of odds, not guarantees. And finally, and this is maybe the most important part, the smartest traders never ever rely on just one clue. A chart pattern is just one piece of a much, much larger puzzle. So the next time you pull up a chart,
Don't just see a bunch of noise. Look for the battle between the bulls and the bears. Look for those floors and ceilings. Look for the stories that they're trying to tell you. You've just learned the first few letters of a whole new alphabet. The only question now is, what are you going to read?